Hey guys, Tim Melvin here, and welcome. Today is actually the 17th, Thursday of October 2024. I'm going to do a run through today of the presentation I'll be doing at the Money Show this weekend. Then we're going to get it out to you guys because I won't usually don't have great taping facilities at the Money Show unless I want to pay to have them done myself. So I definitely want to get this out to everybody. I think the information in it is of interest. It's of some importance, and I think it can make you money. So let's just kind of throw it out there and see what you guys all think. So let's just jump kind of right into it. The real story here, guys, is interest rates are going down. You know it. I know it. The man in the moon knows it. Everybody knows that interest rates are going down. The interest rate cycle has changed. They pivoted. They gave us lots of notice that this was their intent. In fact, it was just about a year ago when they made that initial pivot that started stock prices rocketing higher again. You may not remember, but we had just a reversal. They had broken, and stocks were into a downtrend on that Friday afternoon when it closed for the week, and then Powell pivoted. And everything changed in the next week, and we were right back to and off to the races. Now, it took them a while to actually make that first interest rate cut. It's been made. They went a full 50 basis points. There were talks of whether they were going to do 50 again next time. It doesn't look like it. The economic data does not appear to justify that radical cut. I mean, the jobs market's actually pretty good. So we're probably going to see 25 basis points one or two more times this year, and then a whole series of cuts next year. Bottom line, interest rates are going down. This is from the Fed's internal projections. You can see longer term, they expect Fed funds rates to get down to around 2%. Just kind of jumping in here. Here's the infamous dot plot showing where Fed funds expect it to be in the longer run. And, you're got a one handle and a two handle on interest rates for the foreseeable future. That I think may end up being a little low. We'll talk some more about that, but it makes sense once we get to the other side of all this madness, and it has been madness. And you can almost say that, we've had something of an activist Federal Reserve since 2009, let's call it, where interest rates have been kept artificially low for a very long period of time. They did raise them a little bit, then they came back down because we had a taper tantrum. They tried to raise them again, taper tantrum, came back down. COVID, interest rates went straight to the floor, stayed there, did not move for an extended period of time until we broke the global supply chain by trying to reopen the economy. Everything went crazy. And we saw rates just skyrocket, one of the quickest, 500 basis points moves ever to try to slow down inflation. That's sort of worked so far. So in an attempt to normalize rates, we are going to see rates going back down for at least the rest of this year and into 2025 and possibly beyond. We'll be getting these reductions at the Fed meetings. This is the inflation, PCE inflation, because there's this thought out there that inflation is whooped, it's beaten. It's not. I mean, if you can see, looking out longer term, 2025, 26, 27, and longer, the Fed officials are expecting inflation to be around 2%. That's a very benign view, but inflation is not going away. Okay, and this implies perfection. No global supply chain issues, no escalation of either of the wars, no war with China over Taiwan, no runaway oil or energy demand out of China that accelerates, no excessive spending on green energy that ignites inflation around the world. There's a lot of positive assumptions built in to a baseline long-term 2% inflation rate. But if we are putting this together now, if we're an investor who needs income from our investments, or likes the high dividend yield total return approach that we've used forever because it does dampen down volatility a great bit, gives you an enormous percentage of your cash, of your return in cash that can't be taken out, right? If a stock goes up $1, it can be taken away by market movements the next day. If you get $1 dividend, it's yours. You can do whatever you want with it. You can spend it, you can reinvest it, you can put it into an interest bearing account. All the options are yours. So there are a lot of people, and it makes sense. If you're 50 or over and you're looking out, saying, okay, I've got half a million or a million or however many bucks in the bank, and I really don't want to go through another market crash. I don't want to watch the value of this thing go down 20, 30, 40% or more and feel like I have to start over or take a part-time job to supplement Social Security and pension, or because there's not enough money anymore. You don't want to be exposed to that. So going to an income-oriented total return approach makes a lot of sense. Now, the problem is particularly if you're in the income collection phase, inflation eats away at it over time. And although inflation is not 9% anymore, and we have brought it back down with aggressive interest rate cuts, it's not gone and it's not going away. Best case, you got 2% inflation a year going forward. Worst case, it's going to be worse than that. Now, this is a slide that's something that I just like to get into these discussions and presentations because, we're going to say, well, the Fed's going to do this and the Fed research shows that, and, the Fed's not going away. You can have rallies like this one. You can scream, you can yell, you can want to end the Fed, audit the Fed, burn the Fed. You can want to do a host of things to the Federal Reserve. Ladies and gentlemen, we live in a world dominated by fiat currencies. You can like it, you can hate it. It doesn't really matter what you think about it because it's what we have. And, attempts to go to a gold standard, well, just start here. The global economy is 4 times all the gold ever mined. And then consider that bad actors could arbitrage gold against your currency. And if we are the only gold backed currency anywhere, how do we transact business around the world? There's just so many complications and problems. Fiat's here. We're kind of stuck with it. Bitcoin's really not going to do away with it. Look, my inner libertarian would love the idea of a currency not controlled by the federal government. But the last part of that sentence is exactly why it's not ever really going to replace it. So it doesn't matter what you think about the Fed. You can love them, you can hate them. We're stuck with them. They have a heavy influence on the markets. They have a massive influence on interest rates. So we got to pay attention to what they do. I'll do that part of this for you. And you can be angry at the Fed and you can cuss about them, but just know this: we're stuck with them, and they're going to be here for a very long time. And this is just my futuristic background. Look, 100 years from now, when we're living in this super digital world, and this is what Washington D.C. looks like, that building's still going to be there, still going to be a huge, barring the entire collapse of America, which, unlike many of my colleagues in financial journalism, I don't actually believe is going to happen. There will be changes. There will be things that I like, things that I don't like. I think that my grandchildren will still live in the United States of America, and it'll be a very, forward-thinking, entrepreneurial, vision-created economy, just like it always has been. There will be stumbles and mistakes and all of that, but we'll get there. Washington, D.C. may someday be this pretty. Whether it is or not, the Federal Reserve will be there, still dealing with the twin mandates, and there'll still be rallies outside on the weekends talking about in the Fed. So get used to it. We're stuck with it. There really is not in this global economy a viable alternative. So as investors, we need to know. Okay, so the U.S. inflation rate, we're talking about 2%. As you can see, this goes all the way back to 2000. 2% has only happened in economic collapses and severe pullbacks. Generally speaking, 2% on a longer term is, if we can hold that, that's going to be fantastic. But there's a good chance it will, in fact, run higher and hotter than that for a long period of time. About 2.78%, I think, is the long-term average going back to 2000. So now let's just 2.78. By the way, that's not a bad rate. Okay, that's not terrible. It would actually be a little bit lower than that if it wasn't for that big spike up there at the end of this chart. But now let's just consider this. You retired in 2000. You put your money, you could get a 7% bank CD or treasury bond. I think you could get 8.5 in a corporate bond at the time. You had some alternatives as far as income. So you put your money into one of these things and you wrote it out and you collected the cash. Your purchasing power has devalued by 40%. So everything that you had that you spent $1 for now cost at least $1.40. In most cases, as you know, it's a lot more for a lot of these things. So not only are interest rates now lower, now your value's lost a lot of dollar, even though we've had really, with the exception of the last few years, a fairly benign inflationary environment. So if we take this out to 2050, here's where we are. Your dollar is going to lose 50% purchasing power at just a really benign, super benign 2.5% inflation rate. Again, assuming nothing drastic or dramatic happens in the global economy, no wars, there's no nuclear fusion that makes energy just so super low cost that we see super growth spurts around the United States driving the economy. So that assumes that none of this stuff happens and that we have this kind of just bouncing along economy and a 2.5% inflation. If you retired today and you were using just fixed income investments, you're going to lose half your purchasing power. Okay. If we do get artificial intelligence, you get nuclear fusion, and we become super productive, and that growth rate gets up from 2% of the United States economy to 3-4% for an extended period of time. Inflation is going to go up too, or the administration does not. This is highly likely. You get continued fiscal spending out of the federal government that continues to drive the economy at a higher growth rate than the underlying realities would suggest should be the case. You get higher inflation than that, you lose more purchasing power from your dollar. This has always been a concern. It's not one that we talk about enough. So now we're in an environment, guys, where we've got lower interest rates. Rates are going down. It's going to be harder to earn a decent rate on our cash. It's going to be harder to find alternatives that make a lot of sense and produce a lot of income. But if we go the other way and we go to fixed income and try to lock something up today, we got to deal with the fact that our purchasing power is going to slip away in a very big way. And this is just inflation looking out over, a much longer period of time, going all the way back into the 1960s, in fact. And, if we can do 2.5, that's going to be fantastic. But it's been fairly benign for a very long period of time. But even at 2.5, you lose half of your purchasing power between now and 2050. So if you're 60, you're only dealing with 85. And remember, if we can learn how to reduce our stress and our anger, biotechnology and medicine and medical devices have the potential to increase our lifespan, and it's getting better every day. The only reason the average lifespan is not skyrocketing is because we consist on and I'm putting myself in this, doing stressful stuff and, eating all the foods we shouldn't and all the stuff that you already know. And, your spouse tells you about them all the time. So, inflation is an issue. So we got to deal with, how do I get enough income for today and how do I protect that income because inflation's coming. Okay, there we go. Here's the big question. Why not just buy stocks? Right? Got stock dividends. You can get stocks that, have not cut their dividend for 25 years. The dividend aristocrats, they'll send out dividends. Lots of them have pretty good dividend growth histories. And I'm not saying don't have stocks as part of your portfolio. I'm just saying they can't be the only answer. All right. If you're my age, and I started doing this when I was 2 years old back in 1983, a long time ago. So we've seen the tail end of the Volcker mess. We've seen the 1984 correction of the start of the bull market. We've seen the crash of 87, the mini crash of 89, with the junk bond blow up and the Drexel Burnham Lamb bear mess. We've seen the healthcare reform crisis in the early 90s. We've seen the Thai baht crisis and the Moscow meltdown. We've seen the long term capital implosion. We've seen, of course, the big ones, the internet going kaboom. That's what, it's only a matter of time. Everybody knew it would. If you had any gray in your hair at all, you knew that wasn't going on forever. But when it blew, it took about half everybody's money with it. So then a decade later or 7 years later, we did it again. And we had the great financial crisis, which took another half of everybody's money with them. So just about time you started to get even, they came along and blew it up again. So if you were 60 years old and you're thinking about retiring, it's 2000, you got $1 million. You put it into the stock market. 2000, 6 months later, it all starts going to, and you're down and you've got 600,000. Now you panic, you get out, you don't make it back. About the time you start to feel good about putting the market back in, you slap it back in. Maybe it's up to 700,000 now. Now you're going to lose another 40%. It takes a great deal of conviction to ride both of those out. So now, am I predicting a crash? I am not. I'm suggesting one is possible, and that if you're 50 years old and you're looking at it, you're going, I don't want to work till I'm 85. I don't want to work till I'm 75. I want to have options. I want to be in a position to retire. Then you don't want to be entirely exposed to just the stock market. The same as if you're 65 and you've pulled the plug, you're done, you're home. You've got a little Social Security coming in, maybe you got a fixed pension payment, but you've got a lot of cash sitting there, and now you need it to produce income. So if you go to all stocks and we get a crash, and your $1 million nest egg is down to $700,000, humans being human, you're going to be scared. You're going to be worried. There's going to be an overwhelming impulse to pull the plug and get out. There's going to be fear. There's going to be concern. There's probably going to be some vomiting. So that's why not just buy stocks. We've been going pretty much up and away since March 9th. 2009. There's been some along the way, and of course you had COVID in there, and you had the taper tantrum. You could see some of the madness going on in here, but for the most part, we have been up and away, and it's been a great decade to be a stock investor. The problem with that is, generally speaking, now we've had 14 years of great stock returns. Generally speaking, after a long period of fantastic returns, you know what's coming next, right? We have a period of bad returns. So that's why you don't just buy stocks. This is from Relative Sentiment Technologies, Ray Michelotis, folks. Ray's good, guys. Relative Sentiment Technologies. Go to his website, please. The link's there. They do a lot of great work on the sentiment, the background, institutional activity, the strategic equity outlook. So I stole his slide because after I'm the one-man department, been a little busy, hurricane cleanup, blah, 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 whatever. Ray has allowed me to steal his slides before. Hoping he doesn't get mad at me this time because I did use his slide. But as you can see, this is the aggregate investor allocation to equities, something that some folks have called the perfect market timing tool. And basically, the higher percentage of everything that we have in stocks compared to everything that we have, stocks, bonds, cash, real estate, everything, the higher that percentage is, the lower the 10-year returns are. Ladies and gentlemen, we're way up there. We are back into 1988, 1999 territory. Now, what does that say? This is death of equities, of course. Back in the 1980s, it went great. But you can see now, look, the black line and the blue line, look how closely they are together. The actual and predicted long-term returns of the broader stock market. Here we've got, very high predicted returns, and the actual returns were actually very high. So if you look back here in the death of equities, look how small the percentage of money that we all had in stocks. And I can tell you, as a cold calling broker back in the day, after the 1970s, you got hung up on a lot, and a lot of folks would stay on the phone just to tell you what an awful, rotten person you were for trying to sell them stocks. And that was even worse right after the 1987 crash. People did not care for us stockbroker types very much at all. So, but here you've got very high expected returns over the next decade. We had very high returns. As it plummets down, this is the dot-com bubble. You've got very low expected returns. You know what we had between 2000 and 2010? Very low expected returns. Then we get up here, you get into 2009, very high expected returns. We had them, very high expected returns. Look where we are today. You've got an everything bubble, and that's very much the case. Everything's been inflated. Pick an asset, it doesn't matter. That's starting to unwind. When you look at stocks, it has not bent. We've had this rapid interest rate increase, which should have bent the stock market, and it started to, but we recovered. And just so we had a dip down, it never got into serious, flirted with 20%, but didn't really get there and stay there. Just took right back off. It was a relatively painless sell off in 2022. We're right back to here where we are not seeing this particular indicator suggest that we have really high stock market returns ahead. So now this is the expected equity risk premium. Yeah, it's a negative. U.S. Secular bear markets. With high inflation. You can see, look, we're due for one, and these yellow ones usually lead to one. So we're into a period of time where we're due, way overdue. We haven't had a nice secular bear market since back in here. So it's been over 15 years, coming up on 20 years since we've had a secular bear market. Ray's work is suggesting that one is in the early stages and is more than due, as we're starting to have some blips and back and forth signs that we might be due for a bear market. Are we going to have a bear market? Am I predicting it? I'm suggesting it's possible. I'm suggesting it may even have moved from possible to probable. But these low returns that we talked about here, and there's some more to come, and we'll talk about that real quick. This is the excess CAPE yield. This is the cyclically adjusted 10-year PE ratio of stocks developed by Robert Shiller at Yale. And here he measures the excess cash flow yield on the CAPE and compares it to 10-year treasuries. And if you're, excess return, the higher the excess return is, the higher the projected return on stocks is. There is no excess return right now. It's very low. When rates go lower, so it's not going to be great. And you can see the projected long-term return is, again, very low. Rather than go backwards, this is total market cap to GDP. And Guru Focus, where I got this from, they also do total market cap compared to GDP plus total assets of the Fed, which is kind of smart, actually. That's all the currency and money that's out there. Guys, we're at levels, 2009 levels. I mean, we're at levels that suggest fall down, go boom is potentially a reality. So this is why if you're 50 plus or you're 65 plus and you're trying to switch from an all growth to a total return strategy, and you want more of your strategy in cash, this is why you start to get away from all stocks or just a stock dividend growth strategy. Okay, it's time to start making some decisions. And I do think that stock market dividend growth should still be a part of this. It should not just probably be as big a part as Wall Street is telling you. The joke on Wall Street is they keep telling you and telling you and telling you that you should have all of your money in stocks and this little tiny sliver in bonds or real estate or alternatives. And yeah, and this is a great point in time where you start to flip that thing and that particular equation on your head. So, time for a new game plan. Tried to get a good picture of Weeb Eubank in the it couldn't come up with one. Anyway, so it is definitely time for a new game plan. So what are we looking at? Asset classes in periods of high inflation. And again, this is from the macro team at KKR, who Henry McVeigh and his guys are one of the best in the business. You should be reading their stuff. So real and nominal returns of select asset classes in high and low inflation. Low inflation, stocks are the way to go. If we get higher inflation, you're going to want to be in real estate. So that's just kind of basically the truth of it. Real estate and infrastructure are much better investment opportunities than stocks if we have inflation. Inflation is inevitable. If we stay at the 2.5% level, then a mix of these is, just a third and a third and a third would make a lot of sense. However, as we showed, 2.5% is baseline. There's all sorts of positive things, AI, fusion energy, that can lead to higher growth rates and higher inflation. There's all sorts of terrible things: war, disruptions to the energy supply, global supply chain issues that could cause inflation. So there's always the possibility of much higher inflation. Inflation, as we talked about, erodes your buying ability. You must have inflation insurance in your portfolio. So now this is a very cool study, and it's one of my favorite ones. The CEM benchmarking is a pension benchmarking and consulting firm, and they do a study. This is last year's study, and they just looked at asset classes. What should we do? They looked at what's done the best from 1998 to 2021. Where should we be putting our retirement-oriented money? Private equity comes up number one. You and I can't do that. There's ways we can replicate it. And I say you and I, look, be fair. Some of us can. You can write that multi-million-dollar check and give it to KKR or Blackstone or Apollo, but it's not going to produce any income most of the time. So it'll give you a great long-term return, which works for pension, large state pension funds. Not so much for the guy who's looking to retiring in the next 5 to 10 years or is already retired. What's next? Listed real estate. It outperforms U.S. small cap. It outperforms U.S. large cap. It outperforms foreign equities, private real estate, bonds, pretty much everything. Listed real estate outside of private equity is the clear choice for long-term investment returns. The cool part about listed real estate is you get a significant portion of that return paid to you in cash. So REITs, when we look at real estate, you can look at internally managed real estate funds, value-added opportunistic core funds, fund of funds, whatever it is that they're pitching to you. REITs, just owning the buildings with, a management firm, has outperformed everything else 1998 to 2001. That's from NAREIT and CEM benchmarking. NAREIT being the National Association of Real Estate Investment Trusts. And here we go. This is Morningstar's same kind of look at 1972 to 2022. So we added some years here. What is the highest compound rate of return? REITs beat stocks. They beat international stocks. They beat long-term government bonds. They beat treasury bills. They beat inflation. Now, nobody's telling you this, right? Everybody's saying you got to buy stocks. You got to buy index funds. You got to do this. And it's not true. The idea that you should have 5 or 10% of your money in REITs is ridiculous. You should have a much higher allocation to real estate in your portfolio. And that's probably true if you're 20 or 80. If you go back and you look, this is 50 years, folks. Now you think about the last 50 years and everything that's gone right and wrong in the world. I mean, the 70s themselves were a disaster, but real estate sold off into 76 and actually handily outperformed the stock market going forward. It kept up with stocks through the, go-go 1980s. It did very well in the 1990s. Stocks got ahead of it in the crash in 2000. Real estate caught back up and passed. You should have more of your money in real estate. It doesn't go down as far and it recovers quickly most of the time. The only exception to this has been here. And that, you may remember, was caused by excessive leverage in the financial system and asinine real estate valuations. Those of us that really do a lot with finance and REITs, we were kind of out because we saw that one coming. That was the easiest real estate crash ever. I remember getting a phone call from a friend of mine who was a trader based in Chicago. And I was in Chicago when I got the phone call with another friend of mine. We're sitting in an apartment looking out a couple blocks away. We're up on, like, I want to say the 12th floor. So we can see the lake, and it's snowing and it's cold as hell. And our friend is down in Miami. And this is in 2007. And he says, "Hey, guys, you're not going to believe this." He says, "I'm walking around down here in Miami, in downtown area, all the high rises, and where the big money's supposed to be." And he says, "I can tell you something. I'm looking at these Chicago area banks, and their names are on the posters outside of the condo construction sites." And he said, "Tell you something. None of these are occupied. There's nobody in these things. I'm looking at block after block after block of completed condos with no lights on." He said, "And the banks have financed these under just all kind of crazy arrangements. And come to find out that a lot of these condos were being sold and then immediately sold for 30 and 40% profits and then sold again without anybody ever moving in." We had reached a level of insanity that was identifiable. So actually your return from real estate, if you used a little bit of common sense, would be even better than we are looking at here. And again, we're nowhere near that, nor do I think we'll be anywhere near that for a very long period of time, simply because we won't, I'm not going to say ever, it will be a very, very long time before we have that much leverage in the banking system again, financing real estate. And we're not even seeing it in the non-bank purchasing of commercial real estate right now. So you should have much more of your money in real estate and people that finance real estate than you do. It's way, way significantly outperformed just about every other alternative. So now we get to infrastructure. This is one of my favorite topics. Globally, we've underspent on real estate. Now, infrastructure. China's ahead of us. Australia, Norway, they've done a great job. Japan, we're way behind everybody. Now, look, you just saw it. We saw it right here in Southwest Florida when Milton hit. We had tropical storm force winds here in Lee County and in south of me in Collier County, the Naples area. We are in the subtropics. Our electrical infrastructure should be able to withstand tropical force winds because they're going to happen all the time. It didn't. Half the county lost power. We were dealing with surges and exploding transformers as recently as 2 days ago. So, and then Helene took all that water up into Tennessee and South Carolina and North Carolina, and we had failing bridges and failing roads and all sorts of stuff failed that frankly should not have failed. And we've got problems with water systems. We've got problems with the average water system in the United States. Some of them are 100 years old. It's crazy. The electrical grid, huge percentages of it were designed to last 50 years. Cool. They're 75 years old. So the grid needs an upgrade. We're not spending enough of GDP on infrastructure. That's a fact. The American Society of Civil Engineers has been telling that for years. If you drive, take trains, go into airports, you've known this for quite some time. So this is just infrastructure investing. This is from the good folks at Apollo. Since 2008, Infrastructure funds investing in infrastructure projects have experienced about half of the standard deviation risk and drawdown risk of the S&P 500. So they've done as well as the S&P 500, better during inflationary periods, um, but they've been far less risky and volatile. Cash flows are far less cyclical than many other public equity sectors. Why? Because a lot of that cash flow is coming from the government, and also, to be honest, from quasi governments like utilities, like water companies, like state and local municipalities. So those cash flows are a lot more reliable than cash flows produced by operating profits. Now, and I get it. Look, not a huge fan of government spending either. It's like the Fed. Too bad. It's going to get spent, right? Infrastructure is a hot button campaign issue, always has been. You saw how easily the last infrastructure building went through. As of right now, if we look at all government programs, there's like 815 billion still to be spent, and over 500 billion in tax credits. Most of that is from the infrastructure bill, but shockingly, there's still money left in green energy. There's still money left in pandemic relief and in the CHIPS Act still to be spent. But most of that's going to go to infrastructure. But whoever comes into office midterm, guarantee you, infrastructure is an issue again. And they'll be passing new legislation and spending new money. So, and then if you can see, historical returns have been, correlated not much to stocks at all and negatively to bonds. So infrastructure, solid returns, stable cash flows, lots of this paid in the form of dividends, not very well correlated to stocks, does very well under inflation. So adding infrastructure and real estate to a portfolio gives you inflation protection, gives you inflation protected cash flows without sacrificing returns. It can actually kind of reduce your overall portfolio risk. Okay, megatrends supporting infrastructure investment. I think we know all these. They're at the top of everything. Digitalization. That's AI. That's data centers. That's cell phones. Continued rollout. We're all 5G. What's next? 7G, 9G. Who knows? But there'll be new infrastructure required for it. We're doing small cells now because you absolutely have to have in urban dense population areas, or the broadband begins to degrade. We have to build out broadband systems to rural and poorer communities across the United States and indeed around the world. You're seeing Elon do that with Starlink. So digitalization and the infrastructure needed to support it, and AI is going to be a massive part of this, as are the data centers required for that particular leap forward. Quantum computing will take that even further as that comes online. Decarbonization, it's going to happen. It's not going to happen as quickly as the politicians and pundits and activists are telling you. We're going to have natural gas and crude oil and even coal with us for a lot longer than anybody wants to admit. That's a fact. But it's going to steadily happen, and it's going to require new infrastructure. As part of deglobalization, nuclear and natural gas are going to play a role, which again is going to involve new infrastructure, plants, facilities, pipelines, transmission lines. All of that are going to have to be built. They're all going to produce cash flow. Then deglobalization, that's the rehoming of industries. We're doing semiconductors. Yeah, that's not the only one. There's going to be a lot more of industries coming home. Semiconductors, yes, absolutely. We realized, and I can't believe we ever didn't focus on this. It's a national security risk to not have your semiconductor industry based at home. You need those chips. You need them for military purposes. We were buying our chip network, our chips needed for our high-end military stuff from China. No, you can't do that. Hopefully we have great relations with China and we managed to figure this out. And Charlie Munger was right. We'll stop trying to kill each other because of our mutual interest in trade, but we might not. And when that day comes, we have to have a domestic semiconductor industry. But lots of things need to come home. Pharmaceuticals need to come home. There's just a ton of industries that have been outsourced. They need to come back near homing or home. That requires all new infrastructure. By the way, it also requires lots and lots of industrial real estate. So it's kind of a plus for them too, but we'll leave it here with this. Um, so now it's real estate and infrastructure investment. They both throw off tons and tons of cash, particularly infrastructure once it's up and supported. They tend to respond very well to inflation. The cash flow, you get inflation, rents go up, payments for pipelines, payments for data centers, rents go up, impacting infrastructure positively. So the value of the assets goes up, the cash flows coming off the assets go up. So you get protected cash flows and returns that are not quite as damaged by inflation, and we protect a major portion of our purchasing power, which is critically important. We've got to have the income, and we have to protect the purchasing power of that income. A combination of real estate and infrastructure can help us do exactly that. By the way, I've only got 45 minutes at the Money Show, so I don't think I'm going to make it. I'm going to have to zip through something here. Okay, here's some of my favorites, guys. CTO Realty Growth, and these I am picking out of the Real Income portfolio. I'm sharing a couple of ideas with you out of there. I absolutely love this real estate investment trust. This used to be Consolidated Tomoka, which was a favorite of every value investor, I think, known. I believe Michael Price, going that far back. Everybody had a position in this thing because it was this big undervalued collection of real estate. 2020, they flipped it into a REIT. It's yielding right around 8%, 7.81% we see here. It's trading for way less than asset value, trading less than book, certainly, but I believe it's trading at like 75% of our internal net asset value figure. And, just cranking out a solid dividend. It's, performance has been improving this year as it slowly comes off the bottom. But if we look, guys, this is shopping centers. All right. They got 46 million square feet, 86 or 66% of the portfolio base rents, Georgia, Texas, and Florida. Do you know where everybody wants to be right now in the United States? Is Georgia, Texas, Florida. You can throw some Arizona in there, but they're in the Southeast. They're in the Sun Belt. They're in the markets people want to be in. All of this is, at an 8.6% implied cap rate for the value of the properties. Cap rates are coming down, especially across the high-end retail market. They probably haven't caught up to industrial, but I'm going to say an actual cap rate on a transaction right now might be about 6%, which is why these properties are dramatically undervalued. Very low market cap, very manageable debt. And you can see this was done when the stock was a little bit lower. The dividend looked a little higher, but we're still only about 10 times funds from operations. They've been actively buying new real estate that fits into the plan and selling older real estate. So this is just a nice collection of properties. It's multi-tenant retail assets in areas with really high incomes, high net worths, lots of populations, higher growth, metropolitan statistical areas, MSAs. But always in high growth markets with strong current in-place yields, and they're buying it at discounts to the replacement cost of the thing. And they, by the way, have a lot of legacy assets, and they're going to be selling those, redeploying that back into the core strategy, should continue to drive cash flows and core funds from operations and ultimately dividends higher. By the way, they also own a significant chunk, over 20%, of Alpine Income Property Trust, which is a REIT that they seeded and started. That is a pure play net lease REIT that owns single tenant retail properties on long-term leases. And it brings in management fee income. And guess what? They get a whole bunch of dividend income that comes in. It's a REIT. So the dividend income that comes in the door, it's coming right back out the door to us as part of our dividend. So, and you can see this is the areas that they're in. Within 5 miles of one of their centers, there's 204,861 people, 134,000 within 5 miles average household income, and 85% are in the Urban Land Institute's top 30 markets: Georgia, Florida, Texas, North Carolina, Virginia, Arizona, New Mexico. Head scratcher, but there's only one property there. So these guys have the right centers in the right areas, and their tenants are they're the Whole Foods, they're the Barnes, they're the anchor tenants. They're kind of internet resistant to a very large degree. Now, this is Pine, Alpine income property. And again, very high implied cap rate, 34 states with property, at least one property in it. 67% of the base rates coming from investment grade tenants. 90% coming from solid tenants with solid credit ratings. Look, and these are the single standalones. It's Lowe's, it's Walgreens, it's Walmart, Dollar General, Best Buy, Dick's, Hobby Lobby. They're not going anywhere, right? And they're on super long-term leases with escalation clauses. And it's like a Lowe's, right? The lease is coming up. Really, where are they going to go? You've got the location, you've got the building. There's only so much you can do unless you're going to do a bigger one. Same with Walmart. Why would a Walmart move from this building to that building across the street? It would make no sense. So these leases will tend to be in place for a very long time. And you can see there's always the relationship with the Walgreens, the CVS's, Home Depot, Dollar, and of course the dollar stores are always in there and well represented as well. So this is the net lease real estate business is one of the best businesses out there. There's escalator clauses in the rent in the leases, so the income tends to go up. Occupancy rates tend to be really high because, like I said, they're long-term leases and they're businesses that stayed open. If you recognize, almost every business on this list of tenants stayed open during the pandemic. They are essential businesses that we all use all the time that are not going away. So anyway, CTO Realty Growth, one of my favorite REITs, high yield, outstanding cash flow, increased potential, which means outstanding dividend growth potential. So we've got a great dividend coming in. It's more than you can get on a bond, more than you can get on a CD, more than you can get on most stocks, but it should continue to grow over time. So there's that one. And then Vici Properties, real simple. This is the dividend growth king, currently yielding 5%. This one trades at about, I could say 80% of my estimate of net asset values. This is one of my favorite REITs. I mean, I've been recommending this thing literally for years and years and years. And you can see 7% compounded annual growth rate on the dividend going back to 2018. It's the highest of comparable REITs out there. It's higher than most of the net lease ones. It's higher than all the great dividend growth stories. It's not even close to being a dividend aristocrat because it was formed out of the Caesars reorganization back in 2018. So it's got a ways to go to hit that 25-year threshold. But these guys, this is an exceptionally well-run REIT. They are focused on increasing that dividend and on shareholder total return. What do they own? Well, they own casinos for the most part, 300 hotel rooms. And you can see who it is. It's MGM, it's Harrah's, it's Caesars, it's Mandalay Bay, it's Nobu. I didn't know Nobu had a casino, but that's, we own it. So there we go. But you've got the shopping space, you've got entertainment venues, you've got food and beverage outlets, you've got restaurants and bars, meeting and convention spaces, casinos all over the United States. What's cool about casinos and these hotels, these are super long-term leases. And they all have rent escalators every few years. So the rent's continually going up. You know what else is cool about casinos? They were closed during the pandemic. Do you remember that? Yeah, they all paid their rent. Every single one of them. Nobody missed. There were no problems, no flaws. And your occupancy rate on this stuff, it's 100%. And they own Las Vegas, right? These are all the properties that they own in Las Vegas. If it's someplace cool where you'd like to stay, it's probably leasing the property from Vici. So, and they also, by the way, have 26 acres of undeveloped land strategically located adjacent to the strip that at some point they will do something with or sell, and that will be a massive cash payday for this REIT. So there we go. You can just see that, they are doing business with all the major casino operators in the United States. 74% of the rent's coming from S&P 500 tenants. 80% is coming from SEC reporting tenants. 90% rent rolls with guarantees, triple net leases, which means the tenants are paying maintenance, taxes, and insurance. This is as close to the perfect business as you can get. We own businesses with stable operators who never want to lose the property. They're paying all of the expenses related with the building. They all have great credit. The money comes in each and every month or year, or however these things are paid, depending on the agreement. There's escalators to protect us from inflation, which means the dividend's just going to go up and up and up and up for as long as we own this thing. It's kind of like the ultimate inflation protection. Now, into infrastructure. Infrastructure right now, we have a fondness for closed-end funds for a couple reasons. First off, they can do direct infrastructure projects. They can own a lot more stuff than we can, so we can get exposure to a lot of infrastructure with one click of the mouse. And this is one of my favorites right now. This is the New York Life Insurance CBRE Global Infrastructure Megatrends Fund. And it's the same trends that we talked about earlier. But you can see we've got a 10% dividend yield on this. So the money's just rolling in all the time, comes in monthly. Now, it's 10.3% at today's price. This, by the way, is from CEF Connect. It's a free site done by Nuveen. And if you're going to do closed-end funds, it said it's free. You want to use this because they've got all the information, not just on their funds, all the closed-end funds. So this thing's trading for about 9% less than the assets, the total of all the assets owned by the fund, less than all the stocks and bonds and real estate and projects and cash that they have. Net of all that, that's the net asset value. Because of the psychological soup of the stock market and the way closed-end funds are structured and marketed, this thing actually trades at a discount to the underlying value of the assets. More on that in a moment. So we prefer closed-end funds because they can own a lot more assets. So here's your portfolio holdings. It's Enel SPA, SPA. That's an Italian utility company, obviously utility telephone infrastructure. Enbridge, natural gas. Netlink is the Singapore internet company. Crown Castle is cell phone towers. Atlas Arteria, we're going to talk about that in a second. NextEra Energy, same thing we'll talk about. Engas is a natural gas company. This is all solar and wind farms, renewable energy. National Grid is the UK electric company with pretty major investments in renewable. Vistra is a Texas-based company that's in the power generation business from just about any way you can generate power. So let's just take a look at some of these. Remember, one click of the button, buying shares of this, and we have an ownership interest in all of these things. NextEra Energy, that's Florida Power and Light down here. It's thrown off a nice dividend. Stock's been a tremendous performer. You look in here, it's NextEra Energy, largest electric utility in the United States. It's also one of the largest renewable energy and storage companies. They do fossil fuel generation. They have a fleet of nuclear power plants. Remember, nuclear is going to play an increasing role in decarbonization. So kind of got everything here. We got traditional power generation, we have fossil generation, we have power delivery, we have transmission, we have nuclear fleet. So they're just pretty much in every aspect of the energy and energy infrastructure business. And all of these trends, industrial electrification, moving away from coal and gas-fired plants towards using electricity. Nobody's kind of put together yet that you're going to have to figure out a way to use the natural gas to make the electricity, but we'll let them talk about that. Manufacturing onshoring is going to create tremendous demand for power, as is technology and data centers, smart homes, transport fuels, all of that leading to sharp increases in energy demand, which, again, going to create a need for more infrastructure, for more power, for more nuclear plants, for more natural gas facilities. And we are an owner by virtue of our ownership of the New York Life Mainstay Infrastructure Fund. They've got a wind, solar, and storage fleet, nuclear fleet, fossil fleet. So again, all aspects covered when we own NextEra Energy. Then the fund also owns Crown Castle. And again, stellar performer, right? What does Crown Castle own? They own cell phone towers, 85,000 routes of fiber, and 155,000 small cells across the United States. So if broadband, talking to each other on your cell phone, all of that, you're using their stuff all the time. Um, they rent, obviously, to the cell phone companies. Mobile data growth, which gets bigger all the time, and AI is going to make it even bigger, requires new network investment. It's going to drive demand for towers and small cells all across the United States, and Crown Castle is going to collect a lot of money in rent. Now, Enbridge is the largest liquids pipeline system in the United States, transporting 30% of crude oil products. And they have large export terminal capacities, delivering 20% of the natural gas consumed by over 170 million people in the United States, massive storage and distribution facilities. And they've got a renewable business that's up and coming. But they've got pipelines, as you can see, and facilities all over the continental United States. So they are a huge owner of energy infrastructure. Now, Atlas Arteria, I love this one. They are a toll road company, guys. They focus on running toll roads. They're not getting into any other business. They're staying with the toll roads. They have no interest in branching out, doing anything else. They love this particular business. And, they're pretty good at it because the thing throws off a nice dividend. They're growing cash flows. You get a robust, they call it a robust financial position, fixed rate debt, strong balance sheet. This is a great company. It is a foreign company. You can't buy it. It's got five letters in the ticker, but just by owning the Mainstay Infrastructure Fund, you're an owner of a significant amount of this thing. What is the business? It's toll roads all over the world, the Chicago Skyway. And here's my favorite, because I guarantee you I have donated so much money to these folks. They have the Dulles Toll Road in Northern Virginia. Now, so that's just an example of what you own when you own this fund. You own massive amounts of infrastructure, ports, airports, roads, bridges, lots of energy infrastructure, and so you're just globally exposed to a ton of infrastructure. Remember that discount to NAV. This is the shareholder list. Look who's the top. This is Saba Capital Management. Saba Capital is run by a guy named Boaz Weinstein, who is not only one of the most fascinating investors on the planet right now, he's one of the best. He runs a fixed income and an arbitrage shop. He was the other side of the London whale trades back in the 90s. I don't know, most of you might not remember that. It wasn't the 90s, it was the early 2000s, sorry. There was a trader at JP Morgan in London who had more trading authority than he probably should have, and he took more than that. The more he lost, he got upside down in some trades, and the more he lost, the more he doubled down to try to get it back. And he'd lose and he'd double down. So he had these massive underwater positions. The first one to notice it was Boaz Weinstein. And he saw an aberration in the markets because of the way he looks at data. And he started taking the other side of these trades, made billions of dollars for his firm, eventually went out on his own. In coming into 2020, 2019, he noticed that credit default swaps, basically if credit default swap is if a company goes under, you get paid if you own a credit default swap. If it doesn't stay in business, then you lose what you paid for it's insurance on companies, basically. He noticed that junky companies and good companies were trading at about the same price for the same term credit default swaps. That shouldn't be, right? So he started selling the credit default swaps on the good companies and buying the one on the bad companies because the risk was just completely mispriced. Long story short, it paid off. It paid off big. He didn't know COVID was coming. He never saw it coming. However, when you got there, those junky companies where he bought them, they collapsed. He got paid. They were fine. They kept paying their bills. So he just collected those premiums. It was a huge trade. The fund was up in 2020 about 100%, with most of that made in a single month. This guy is brilliant. And he turned his face towards closed-end fund arbitrage, which is simply, we're going to buy these heavily discounted closed-end funds, and we're going to begin to have discussions with management about what they should do to reduce the discount. They can do buybacks, they can do tender offers, they can convert it to an ETF. So a ton of things they can do. Saba has been winning, and he's been winning against the big fund groups because for years you couldn't take on Blackstone, you couldn't take on Nuveen. He's taken them on. He's winning the proxy fights. When he loses the proxy fight, he's taking them to court, and he's winning. Now, he just lost a proxy fight with the Mainstay Fund. Look for what's next because he has a pretty sound basis to follow this up with the same suits that he's filed against Nuveen and against BlackRock. I'm sorry, not Blackstone. So you've got a lot going on here. You've got a closed-end fund that is investing in infrastructure projects that throw off a lot of inflation-proof income. You've got it, you're buying it at a discount to net asset value. You're collecting monthly dividends, and you could get a sharp payday because if he forces this thing to go open-ended or to convert to an ETF or to liquidate and give us our cash back, that's not going to happen here. Or do a tender offer, we're going to make an immediate boom, 10% pop on this thing. So you've got 10% just in dividends. You've got the potential for appreciation because the assets are going to go up over time. They become more valuable. So you've got 10%, call it another 5 annualized, but then you've got the potential for an instant pop of about 12% if this thing trades up the net asset value. So a lot going on. It's why we love closed-end funds, particularly for infrastructure. And we do pay very close attention to who owns it because the more activists we have on this thing, like if you come right down here, Raymond James will vote with the activists. Carpus Management is a closed-end fund specialist. They've been known to go activist. Since Saba's in there, nobody else really has to. So they've got a large position. So you got a lot of people here that would go along with Saba if they really push this thing hard to get an open ending or to force the board at some point in time. So if it just chugs along and pays us 10% and the assets go up a little bit a year, we're good. If we get the pop, well, we're good with that too. So what we've striving to do in Real Income is we have a two-portfolio approach. There's the income portfolio, the total return portfolio. The total return portfolio is primarily real estate investment trusts where we own assets that are producing income that's going to grow over time. It's got about a 5.5% initial yield, so you're doing better than just about anything else you can put your money into. The real estate is dramatically did you like that effect for dramatically? Dramatically undervalued. On average, it's probably 25 to 30% upside just to trade to net asset value. Here's the thing. Real estate's been going down steadily for the last several years. Now it's going to turn around and go higher. So those net asset values are going to be going up while the gap closes. In the meantime, we've got income that's going to continue growing. So we've got a starter yield at 5.5%. Money doubles in 7 years, I think. No, about 10, a little more than 10 years. I'm sorry. Now I got to come back and do the calculations. All right, about 13 years, money double. The income flows will double off that if it doesn't grow, but it's going to grow. So your dividend payment probably you look for it to double every 10 years, let's say. So it'll be 11%. Most importantly, dividends grow. All they got to do is grow faster than inflation, and your purchasing power is protected. Then the income side of the portfolio, we're looking to buy heavily discounted assets, bonds, closed-end funds, preferred stocks that are issued by infrastructure and real estate companies, trading at far less than the face value or net asset value of the security that we own, that are producing very high dividend flows, and we have a dividend yield of about 8% in that particular portfolio. Putting them all together, we're going to be throwing out over 7% from this portfolio, and the dividend income is going to be growing at a rate that should more than offset inflation over time, and it's all steeply discounted, so there is lots of upside on both sides, both to the REITs and to the income producing securities that we own in the income portfolio. So if you're as concerned, and you should be, at least moderately, about everything that's going on out there in the world, and you're worried about the impact of inflation, the fact that interest rates are going down, check out the Real Income Report at realincomereport.beehive.com, and hopefully you'll join us and become a member. I think that you will end up being extremely happy that you did. So anyway, guys, we took over an hour. How on earth I'll get this down to 45 minutes? I don't know, but we'll give it a shot. So if you're in Orlando at the Money Show, Saturday morning, I'm doing a uh, income investing panel. I'll be moderating that with some folks, and then later in the afternoon, I think at 2:45, I will be redoing this presentation live and in purpose. Find me. Let's grab a soda or coffee and chat while we're there. I'll be there for a couple days, so hopefully you're there and I see you there. And I look forward to meeting and talking with you. Otherwise, sign up. Join the Real Income Report, come along on this adventure and what should be a very profitable journey along with us. Thanks, everybody.